Jamie Dimon, the CEO of JPMorgan Chase, is widely recognized as one of the most respected bankers in history. And while I typically delve into the minds of the world's top investors, there's no denying that when it comes to the global economy, Dimon's unique position often affords him incredible insight into the current state of affairs worldwide. He's involved in everything happening here and abroad. They have over 60 million clients and employ over 300,000 people worldwide. They have business in the Middle East and China, and are heavily involved, of course, in politics in Washington. So it's fair to say that Jamie, as CEO of JP Morgan, has a pretty good view of the economy, which makes it a bit worrisome when he releases his annual letter and basically says he's super concerned about everything. But in this video, we're going a bit beyond his pure alarmist video on YouTube, and we're going to closely analyze his recent letter to understand exactly why Dimon believes this may be the most critical period the world has witnessed in decades. And it starts with Jamie's overview of the situation within the borders of the US. It's important to note that the economy is being driven by large amounts of government spending and past stimulus. There's also a growing need to increase spending as we continue to transition to a greener economy, restructuring global supply chains, increasing military spending, and combating rising healthcare costs. This could lead to more persistent inflation and higher rates than markets expect. As I've discussed on the channel before, the US government has been operating with deficits every year since 2002. Now, at a basic level, this means the government spends more than it earns, which is acceptable in the short term because the US Federal Reserve, the Fed, has the ability to print money and buy government bonds to effectively lend this new money to the government. The problem is that this action is inflationary. Increasing the money supply is an inflationary force, and the issue is that over the past 20 years, the US government has been diving deeper and deeper into deficit, which now makes them need to borrow more and more money each year just to try to fund their lifestyle. Now, the Federal Reserve isn't the only player lending money to the government. For example, investors and even foreign nations also do. But there are concerns at the moment that if these buyers pull back, the US will have no choice but for the Fed to print more and more money to quench the government's thirst for money, which would likely cause more inflation. The other alternative is for the US to cut spending. But Dimon notes that this is rather unlikely, mentioning that in addition to their daily spending, they also need to channel money into the new green economy, restructuring global supply chains through things like the CHIPS Act, boosting their military power, and funding their healthcare system. Many key economic indicators today remain good and possibly improving, including inflation. But looking into the future, we must consider conditions that will affect the future. For example, there seem to be a large number of persistent inflationary pressures that are likely to continue. All of the following factors appear to be inflationary: ongoing fiscal spending, remilitarization of the world, restructuring of global trade, capital needs of the new green economy, and possibly higher energy costs in the future due to lack of necessary investment in energy infrastructure. So even before we look outside the US borders, there are very complicated situations forming, the biggest of which is probably this need to spend money on top of an already painful deficit, but inflation is still not fully under control and is indeed at risk of rising again. And that leads Jamie to sound the alarm, especially for investors out there, who are mostly getting a bit too optimistic, with the S&P 500 rising an impressive 22% in the last year alone. Equity values, by many measures, are at the upper end of the valuation range, and credit spreads are extremely tight. Markets seem to be pricing in a 70 to 80% chance of a soft landing, moderate growth along with declining inflation and interest rates. I believe the odds are much lower than that. A soft landing is simply the idea that after the big inflation surge the US experienced in 2021 and the first half of 2022, interest rate hikes will be able to slow down the economy, reduce inflation, but won't cause a recession. And so far, as Dimon notes, the market is really betting on this situation occurring, and there are some indicators that this scenario is becoming reality. Interest rates have been raised and inflation has dropped significantly, but the unemployment rate remains low and consumers are still spending. But Jamie suggests that the economy will experience a soft landing with a much lower probability than the 70 to 80% that investors are betting on. This is him explaining exactly this issue in a recent interview. I think there are things out there that are somewhat concerning that we're keeping an eye on, and why are we doing so well? A lot of it is fiscal spending, and fiscal spending also has a multiplier, so I just think it may not come down as quickly and people may be surprised. So when people talk about the market kind of pricing in a soft landing, that may well happen, but the chances of 70 or 80%, I would give half of that, that's it. And while there are many factors within the US borders that give Dimon reason to believe that a soft landing has a much lower probability than the 70 to 80% probability expected by the market, upon reading his annual letter, it became clear that the main reason he gives a much lower probability of inflation and being able to reduce interest rates is actually because of what's happening when you look outside the US borders. Sure, maybe data from the US suggest everyone's fine, but Dimon is particularly concerned that the geopolitical landscape of the world, as we see it today, could have a decent impact on the US economy worldwide. 2023 was yet another year of significant challenges, from the terrible wars and ongoing violence in the Middle East and Ukraine to the growing terrorist activity and geopolitical tensions, especially with China. The ongoing wars in Ukraine and the Middle East continue to have the potential to disrupt energy and food markets, migration, and military and economic relationships. Besides the terrible human cost, these significant and somewhat unprecedented forces make us remain cautious. And that's Jamie very eloquently saying that conflicts among other nations, both militarily and economically, may well play a significant role in future inflation, which may actually dictate what the US needs to do with its interest rates. Take the case study of Russia's invasion of Ukraine. Both Russia and Ukraine are major global suppliers of agricultural products like wheat, corn, barley, and sunflower oil. When the conflict began, it restricted access to these commodities, leading to scarcity and higher prices globally. Russia is one of the world's largest producers of oil and natural gas. The invasion, along with subsequent sanctions imposed by Western countries and other geopolitical responses, severely disrupted global energy markets. We know that European countries heavily dependent on Russian gas faced huge challenges, leading to a significant increase in energy prices, and that's just the beginning. You have attacks in the Red Sea causing the rerouting of cargo ships. The Middle East, which is a major global oil supplier, is obviously in conflict. China and the US are waging an economic battle. Jamie's point is that these external factors can also have massive impacts on inflation in the United States. While messing with the money supply and raising and lowering interest rates can affect the demand side of the inflation equation, what's happening around the world can and indeed does affect the supply side of the equation. Russia's invasion of Ukraine and the subsequent appalling attack on Israel and ongoing violence in the Middle East should have undone many assumptions about the direction of future security and stability, bringing us to this crucial moment in history. America and the free Western world can no longer maintain a false sense of security based on the illusion that dictatorships and oppressive nations will not use their economic and military powers to advance their goals, particularly against what they perceive as weak, incompetent, and disorganized Western democracies. In a turbulent world, we are reminded that national security is and always will be paramount, even if its importance seems to diminish in quiet times. The impacts of these geopolitical and economic forces are large and somewhat unprecedented. They may not be fully understood until they unfold fully over several years. And while many may argue that Jamie Dimon is just a very wealthy banker trying to create a bit of FOMO, fear of missing out, to get more business for his company, it's hard to ignore the fact that what he's saying has a certain degree of logic and reason behind it. So for all the investors out there, maybe it's time to take a look at your portfolio and ask yourself if you're really prepared for everything the future holds.